Hi everyone, welcome to our new video series titled Investment 201. Now we call it this way, Investment 201 because last year we did a video series titled Investment 101 and it was very well received by our listeners. So this year we created this title, a bit tongue-in-cheek, but essentially it means that we are going to still talk about investments, but a bit more in-depth and perhaps slightly more complex. Right? So for those who are interested in the previous series, Investment 101, the link is in the description. And for this year, we'll be talking about 5 main topics, which is namely Tariff and Deglobalisation, investing in China, the ABC investment formula by Dr. Peng, private assets, and lastly, we'll be talking about bond ETFs and funds. So join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi, Dr. Peng, great to have you back.
Thank you, Isaac. It's great to be back and great to be talking to our listeners and viewers on Investment 201.
Yeah, we're very glad to have you back because last year, in terms of the ratings, in terms of the feedback that we got from the first series, it's very favorable. So it's a pleasure to have you back.
That's great. That's glad that people liked it, and hopefully they'll also enjoy 201.
Right. So let's jump right straight to today's topic, which is tariffs and deglobalization. Right. So I can't talk about this without talking about what happened back in I would say in April. But maybe you can just share with our listeners about what is how did this tariff conversation start, and what is the current situation right now?
Yeah. So the tariff, mainly brought up by President Trump. Over the past 10 or so years, because President Trump has been the presidential candidate in the last 3 U.S. Presidential election. And he won twice. In the middle, he lost once. But nonetheless, he's been talking about this for the last 3 elections, almost 10 years now. And if you look at further, it's he used it as one of his major campaign policy changes to really bring manufacture back to the U.S. And to some degree, this is a pillar in terms of what he tried to do to make America great again. Now, if you look at further, what has happened. So since Second World War, the U.S. being the biggest superpower has really promoted global trade, removing global trade barriers. And what happened is that the economy become more and more global, and companies try to not only explore how to make things, service people more effectively, but also most efficiently. And over the past 30 years, particularly Asia has seen a lot of manufacturing and so on and so forth, manufacturing and service moved to here. And what happened is that in certain countries, such as more developed countries, US, Europe, they lost a lot of jobs, particularly jobs that don't require a lot of advanced skills and can be easily moved to other emerging countries. And from a company perspective, operating company perspective, it's more cost efficient. But from a employee, if I'm a employee or worker's perspective, the job of those type of job that I can handle in the U.S. gets shrinked quite a bit. And so this caused a phenomenal, if you look at the last 20 years, U.S. Workers, their income and their job opportunities, actually, because of this globalization, they have to compete with workers in China, in Vietnam, in Thailand, and so on and so forth. Their income hasn't really increased, actually dropped. And so from a company perspective, globalization has been great, record profit, all of these things. But from an employee and from a citizen voter's perspective, more and more people are disadvantaged by this globalization. And so this has caused a lot of resentment to globalization. And so this is one thing. The second thing, if you look at globalization, it means that even for a pencil, the late Milton Friedman actually recorded a pencil video, basically talk about, where's the pencil, the wood come from, where's the lead come from, where's the rubber, all over the world. So, even for a small thing like a pencil, you cannot manufacture yourself oftentimes. And this was very obvious during COVID, where many what we consider, advanced developed countries couldn't manufacture basic things such as masks, the certain medical equipments, and when things got disrupted, the supply chain, they're in a huge disadvantage, and so that's a second factor had people in America, the politicians rethink about globalization. So those are the underlying reasons. And then when Trump was elected, he started more aggressively, unilaterally using the tariffs as a way to reverse some of these trends and to also to some degree to address his voters' concerns.
Right, and there's also another angle that beyond jobs and of course, there is also national defense that is often brought up.
Yes,
when it comes to bringing back manufacturing.
That's right.
So could you share with our listeners more about the angle as well?
Yes. So just like we talked about masks during COVID, and if you look at national defense, it's of similar things. A lot of things gets been outsourced to elsewhere globally. For example, shipbuilding used to be a huge pillar in the U.S. and huge part of the defense. But if you look at today, the number of ships that the U.S. build versus China or South Korea or Japan, I think I read a statistics, it's like 200 to 1. So there's, in terms of tonnage, if U.S. build, 100,000 tons of ships, the capacity, China built 200 times more.
Wow.
So you can see the balance, because globalization has created a huge imbalance. If you are the U.S., if you're thinking about national defense, you're thinking about these critical elements that you would need in a crisis or in a war type of situation, you no longer have access to it because you outsourced to other countries. And in a situation of crisis, you may not be able to continue to have access to. Another example is steel, which is very fundamental. U.S. was once the largest steel producer globally, right? That's how they win the Second World War. But if you look at today, there's only one steel company, one steel mill still running in the U.S.
U.S. Steel.
U.S. Steel. And last year made headline news because Nippon Steel tried to buy it from Japan, tried to buy it, and it got vetoed by President Biden. So this is sort of these symbols of globalization caused imbalance, even though it became more cost efficient. But in situation of stress, disruption, whether it's COVID or nobody wants to see war, but in a situation like war, you cannot produce enough material.
Right. So it becomes like cost efficiency versus, or rather efficiency versus resilience, security
versus efficiency.
Right. Yeah. And when it comes to national defense, I think the example is probably in World War II, where the Germans could change their car companies to from producing cars, they could just switch to producing tanks, right? I think, that's one way that perhaps maybe Trump was thinking about. If need be, he wouldn't have the manufacturing capability to do so if there is a war breaks out.
That's correct. So I think there's you gotta have certain amount of balance so that at least I'm not 100% or totally rely on outside when there's potential disruption.
Right. So I think most people are in agreement of these problems, right? But I think it's more of how they are trying to deal with it.
That's
right.
That's right.
So I think many economists, well-known economists, have said that the method of doing a blanket tariff is going to be quite detrimental to the economy. Maybe you can explain how it makes it how it affects the economy in a negative way.
So it's kind of like so if you think about it in terms of trade, it basically means that let's suppose you're Italian, I'm Swiss, I'm pretty good at manufacturing watches, and you're very good at making spaghettis, all of these wonderful food. So if I want to enjoy good food, I can trade with you, right? And that's what, in terms of economic principle, is called comparative advantage. So meaning that I can do what I'm good at, and do very well, and then use the trade to exchange to things that I'm not very good at. But then I can enjoy both what I do very well, and then I can also, by trade, enjoy things I'm not doing very well. And so that's really the fundamental principle, and that works wonderfully well. In many examples we can find, like Swiss and Italian. And so in this process, we each lower the cost of us, enjoying these things. So collectively, if you look at globally or entire human population or as a society, we're much better off, right? Rather than me just making watches and eating, not so good food, I can use trade, getting all of these wonderful things. So collectively, we're all very good. But there are going to be certain people, during this trade get disadvantaged. So, for example, what if I'm a watchmaker in Italy? Because Swiss make better watches, I lost my job. I'm worse off. But over time, there has been a small minority, that the trade has benefited everybody. What happened, like we just talked about the last 20, 30 years, is that the people get disadvantaged in particular developing country. U.S. as a representative became bigger and bigger, and that's become a much larger political problem. Even though from a global perspective, everybody's still doing well.
Right, and beyond the simple, country to country different countries specializing in different goods. The example of the pencil that you mentioned, there's sometimes one single good have multiple countries involved in it as well. So I think if tariff is implemented, in a way that is a blanket tariff, it's gonna affect the
That's
cost
correct.
a lot.
You're absolutely right. So if you unilaterally or bilaterally increase the tariff, it will increase the price for everybody, that for trade, and ultimately impact the consumers. So despite you can see the recent incidents, despite President Trump saying, "Hey, China is going to pay the tariff, the Mexicans are going to pay the tariff," in the end, you saw what's going to happen is Walmart, the largest retailer, is raising price, and who's paying for the price is the consumers. Yeah,
right. And when it comes to the investment landscape, now we know that of course the tariff was imposed, then it was paused, it was imposed, then it was paused. But let's say the tariff goes through, right? And I'm sure that it has implications when it comes to in the investment landscape, right? So we've been talking about the economy, but how does it, the market sold off 20% in April, right? Of course, it has rebounded quite a bit as of today. We don't know if it's, by the time when the video is released, whether it would have, is still at this level, but I think, the market sold off quite sharply. Could you explain why?
So the market sold off sharply is because there's a couple of things. One of them is the degree of the tariff that Trump first proposed is quite high, much higher than what it used to be. So before the Trump tariff hikes, the tariffs among developing countries like U.S., France, UK, Germany, Canada, Australia, the tariff levels is actually below 5%. So it's like 2 to 3%. Okay, and the tariff levels between some emerging countries like India, China, or U.S. in that mix is probably around 10%. So at a pretty low level.
Yeah.
But then you think about Trump at the height, with China in that escalating, tariff war, raised ultimately to 145. That basically prohibited any trade that going on within those two countries. Not only that, the other thing I think so the first thing is the level of tariff went up.
I think just to explain that if it gets so high at 145%, there's essentially no more trade. So even if it goes to 300%, 400%, there's no difference because at that level, there's no trade.
There's no
that
trade
is feasible to be made.
Because it became too expensive. So let's say, even though I like Italian spaghetti, but it's so expensive I cannot consume it, so it doesn't really matter. So at 145% of tariff, it essentially killed most of the trade. Now, that's the first surprise. Okay, the second surprise is that it's so widely spread. And just give you an example. For example, the Americans' closest ally is Canada. For years, no matter what American does, Canada typically follows. And for those of you who remember, in Trump's first term, where he raised the tariff with China, right? The first country followed is Canada. So they're like twin brothers, right? But then you with the tariff and as well as the other rhetoric from Trump, he's talking about Canada becoming the 51st state. He raised tariff on Canadian-made auto and auto part. So how widespread also caught people by surprise. And so, within a very short period of time, level went up, every trade went up. And that's a huge disruption. Huge disruption. It's kind of like COVID. Nothing is moving. And also, with all these changes, and so people started to really worry what the economy is going to do, and likelihood of going into recession become much bigger, and ultimately it also impacted the U.S. dollar status, because U.S. dollar is the most popular currency that people settle their trades globally. Around probably 70 to 80% of trades happen using US dollar as the currency. And so if the trade started to stop, the demand for US dollar going to drop a lot. And if the demand for US dollar drops, that's not going to be good for any of these US dollar denominated assets, particularly for US government bond, because we know the US government needs to continue to raise money to sell bond to finance their physical and government deficit. And if US dollar became less, people don't want US dollar, they will now want US bonds. And if people don't want US bonds, US need to continue to sell. That has huge implications to the financial market and so on and so forth.
Right. So to summarize, basically tariff would potentially cause a recession, cause a sell-off in the dollar, less demand for US bonds, which cause bond prices to fall, and yields to go up, and of course, to price in a recession, equities would fall. So because demand would be falling, less demand for goods and services sold by these companies, and that's why when the tariff was announced, it was all priced in because the markets are quite efficient.
So you see over a couple of days, the market dropped 20%.
Okay, and so this also brings about what we call deglobalisation, right? So globalization is where the world is becoming smaller, there's more trades. Typically, for the past decades, right, free trade was something that countries strive towards. But now that we are deglobalizing, and it seems like we're going to stay that way, right? I mean, on the current path that we are, at least we are not going back to how globalized we were before all these, right? So how should we view this, and how should we be worried about this?
Absolutely, I think we definitely need to be worried. And so if you look at, I mentioned, where Trump came from and where the deeper resentment by these, employees who has been worse off over the past 20, 30 years. So there's a strong desire to, stop imported goods because they view they've lost their jobs to these foreign manufacturers. And Trump is trying to use this tariff to essentially increase the price of foreign goods and to some degree will increase the competitiveness of the US-based manufacturers to some degree.
Right. And I think when it comes to tariffs, right, I mean, there's a way to do it more strategically.
Yes.
Right? I mean, like you mentioned, there's like the example I can think of the top of my head is, let's say you have an infant industry, right? And
you protect that.
You want to protect that. You can use tariff until they are able to scale up to speed to compete.
That's right.
But the way that Trump is doing it is sort of blanket
See,
way.
that's kind of your earlier point. I think a lot of people understand that the past 20, 30 years, people are worse off, even in COVID, in conflict situations. There are certain resources you need to be able to mobilize and manufacture within your own country. So we all understand that. So there is some legitimate reasons from the US perspective to raise some tariff. But the way he did it so fast, so high, so broad, really caught a lot of people, by surprise, and have huge impacts on all of these market we talked about. Then the reason, if you go back, is that if you read, his book called The Art of the Deal, he actually talked about it. The way that he liked to negotiate these things is that he is going to first raise the stake very, very high. Just like what he did on these tariff, raise a very, very high number and big demand. And then he's going to create chaos. That's what he wrote in his Art of Deals, is that he's going to create chaos, make the other side very, very uncomfortable. And then he's going to negotiate and close the deal. So these are tactics he has, quote unquote, mastered when he was doing real estate and so forth. And now he's using it dealing with countries. Now, it created a lot of chaotic situation because nobody knows what he's going to do today versus tomorrow. And we already seen, back and forth several times, right? And so that's just part of his deal-making mentality, or the approach he takes.
A more strongman approach.
Yeah, more strongman, but a lot of it is bluffing, sometimes. So nobody knows. And but the thing that we do know is that this is going to increase a lot of uncertainty, short-term volatility to the market, right? So when he, pushed up the tariff up, market obviously dropped. And when he say, 90-day suspension, let's not do it, market came back. A couple of days ago, he said, I'm going to put on 50% for everything from Europe. Market dropped again. Now he's backing off from that again.
Yeah.
So one thing I think we learned from this, given how he wants to do these deals, or he wants to handle the tariff, it's likely we're going to see a lot more short-term volatility in the market. The up and downs are going to be more often.
So now that we have the knowledge of all of this, but as an investor, right, the questions I think that all of listeners would have is that, what should I do now? Right, knowing all of this, so should I trim my US position? Should I stay out of the market until things settles? Now, what is the investment response that we should do in this situation?
So first of all, I think even though historically we haven't had, exact the same triggers trigger the volatility, but we have had high volatility, high short-term risk, and so forth. So during this period of time, rather than get caught up in the tariff, exactly how much, what's it going to look like, nobody knows. I don't think even Trump himself knows. We should go back to the investment principles, diversification, participating in the long-term, economic gain. No matter what tariff is going to be, there's going to continue to be economic output. There's going to be productivity gain. So as an investor, we want to anchor ourselves to those long-term driver returns. And then at the same time, continue to diversify across the board. Now, I want to further emphasize diversification, because if you think about it, before the deglobalization, using your term, the globalization has come to a degree. For example, if I'm investing into the S&P 500, a large part of S&P 500's revenue profit came from outside the US. The latest figure is around 40%. At one point, it's more than 50%. So in other words, when I'm investing in the US S&P index or US company, I'm essentially buying global already, because these firms are so globalized, right? So now with this, going the other way, I need to be even more careful about more global diversification. So to continue to rely on investing in one or two countries, even as big as US, as globalized as it has been, it's probably going to fall short. So I want to make sure I have investment carefully designed across these global markets that meets the new landscape, so to speak.
So so what you're saying is that yes, even though if let's say someone invests in just the S&P 500, revenues are from all around the world, so there's that degree of diversification, but it's still good to
properly diversify
across other countries, especially so now, because revenues from other countries
are going to
fall.
be dropped. Yes, that's pretty sure. So that's the first thing. The second thing is, we mentioned there's going to be a lot of short-term volatility. So you're going to see market went up, 5, 6, 7% a day, and then the next day drops 5, 6, 7%. So what you wanted to do is, one, make sure the money you're investing into the market are long-term money. And then secondly, if you have a need to invest more money into the stock market over time, or you have a need to withdraw money, you want to be careful. You probably want to apply a dollar cost averaging perspective. Just spread it out a little bit. So let's say, hey, I need to buy HDB in Singapore, and I'm going to withdraw $300,000 from my funds and my portfolio. Well, you probably want to spread it out, because you don't want to get caught in a situation that certain announcement is being made in Washington, and then market drop 10%, and you end up withdrawing on the same day. So spread it out a little bit, and it will help you smooth out the up and downs, depends on what day it is and the announcement. Same thing, when you're buying, spread out a little bit. So that initial dollar and withdrawal, particularly the withdrawals, the dollar cost averaging become a lot more important. Don't all of a sudden, withdraw a lot of money, because there's a lot of short-term volatility.
Right. So if essentially, stay put, right? Stick to your plan, continue to diversify globally. And if you need the money, right, sell it instead of one shot. Maybe you can take the emotion out of it by dollar cost averaging out. And also, if you are building up your portfolio, you can take the emotion out of it by dollar cost averaging in.
And then lastly, don't time the market. It's very tempting right now, because say, oh man, it's went up 10% or went down 10%. Should I sell? Don't try to do that. We have already seen the whips lash, couple times. Today's on, tomorrow's off, right? So don't do that. The other thing I want to emphasize is that previously, because US dollar is so dominant, and from a diversification perspective, we talked about diversify across different stock market, diversify and so on. So now it's probably even a stronger emphasis should be put on think about diversifying your currency exposure. So previously, if you only had US dollar exposure, this is probably a good time to think about to diversify across a few more.
And that is actually built into a globally diversified portfolio that is not FX
That's right, hedged. Yes,
right?
yes.
So if you leave your diversified portfolio FX unhedged,
then you naturally
have currency diversification.
Yeah.
Okay. So investment principle stays true, right? Before all this chaos, after all this chaos, investment, the principles remain the same.
Correct. So don't get caught up too much in the up and downs. What's Trump saying and all? It's very easy to get that, but just remember, the economic output will continue, the productivity will continue to go up. And we need to be vigilant. We need to adjust these things. Try to be more diversified across countries, across market, across currency, and don't make sudden moves. Don't try to time the market.
Right. Okay, with that, we can end today's episode. Thank you so much, Dr. Peng, for your time and insights on tariff and deglobalisation.
Thank you, Isaac. Really good to talk to our viewers on this topic.
Yes, it's quite complex, so it's good that you can kind of break it down and also end off with what to do, right? I think that's the most important thing for most of our listeners.
Hopefully, that's helpful.
Right, to all our listeners, I hope you enjoyed today's episode. If you like this episode, please subscribe if you haven't done so already, and follow us on social media if you have not done so already. As always, thank you for listening, and I'll see you all in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.